Your financial failure is not a lack of intelligence but a predictable biological byproduct of a brain wired to chase $200 in Bitcoin while ignoring credit card debt compounding at 24%. The path to wealth requires pivoting away from the dopamine hit of the next big stock and toward a boring, automated system that removes human emotion from the equation entirely. Here are the logical steps to rewiring your financial architecture before your short-term instincts sabotage your long-term survival. Imagine the sudden, heavy drop in your gut when you finally summon the courage to log into your brokerage portal after a long season of looking the other way. You stare at the screen and realize your entire strategy has been upside down, leaving you with the nagging suspicion that your internal compass is permanently broken. This is the moment where the scattered reality of your ledger stares back at you. You might see a lonely $47 sitting in a Roth IRA, a speculative $200 stake in Bitcoin, and the ghost of a $400 from a previous life that has been gathering dust for years. Meanwhile, in the dark corners of your balance sheet, credit card balances are swelling aggressively under a 24% interest rate. Does that visceral sense of dread feel familiar to you? You need to pay close attention to the mechanics of this situation, because understanding the underlying architecture of your choices is the only way to pivot from self-sabotage toward a completely renovated financial mindset. The prevailing myth is that this mess is born of sloth or a failure to grasp the basics of arithmetic, but that is a fundamental misunderstanding of the human condition. You are not a defective individual, nor are you uniquely incapable of managing a checkbook. Instead, you are a biological entity operating on ancient software that was never designed for the modern world. Your gray matter is hardwired to seize a piece of fruit today rather than wait for an orchard a decade from now. This evolutionary bias is constantly exploited by a financial industry that functions like a high-tech casino, designed to tug at your neurological triggers rather than fortify your long-term security. Even high-income earners are frequently trapped in this cycle, living from one deposit to the next because their primal instincts are being outmaneuvered by a system built for friction and instant gratification. Think of the average person's approach to the markets as if they were wandering through a high-stakes carnival with a handful of tickets. They are naturally drawn to the neon lights of the most thrilling rides, hoping to be the genius who spotted the next Tesla or Nvidia before the rest of the world caught on. This desire to be perceived as sharp and ahead of the curve acts like a powerful drug. However, while they are chasing the high of a potential windfall, their high-interest debt is eroding their foundation like a termite infestation in the basement of a skyscraper. It is a quiet, devastating process that lacks the adrenaline of a stock market gain. Because the burden of debt feels like a gray, distant fog rather than a vivid spark, it fails to trigger the urgency required to fix it. We are biologically inclined to pursue the bright and the bold while ignoring the mundane tasks that actually build a fortress. To break this cycle, you must acknowledge that your own attention and reward systems are the primary obstacles, not just the numbers on the page. The truth that few admit is that victory does not come from trying to exert more willpower. If you rely on your ability to make the virtuous choice every time a paycheck hits your account, you have already lost the battle against a world optimized for your distraction. The real breakthrough occurs when you stop trying to win the internal argument and instead build a mechanical structure that fires your brain from the job of decision-making entirely. You must transition toward a strategy that functions on autopilot, ensuring that the necessary, unexciting movements of capital happen regardless of your mood or your impulses. This shift from manual struggle to systemic automation is the only way to survive a landscape that is actively trying to hijack your future for a short-term thrill. Every single fiscal crossroad you encounter acts like a slow leak in your mental battery. By the time the evening shadows stretch across your desk and you are forced to choose between allocating $200 toward your future or surrendering to a fleeting indulgence, your executive function is effectively depleted. You aren't operating with the cold precision of a grandmaster, you are operating with a fatigued prehistoric brain that is screaming for hits of novelty, comfort, and immediate gratification. Left to its own devices, this exhausted gray matter will choose the path of least resistance every time. If you want to survive your own biology, you have to stop treating your finances as a series of nightly tests of character and start treating them as a mechanical process that must be set to run on autopilot. We must stop attempting to bulldoze our innate flaws and instead architect a fortress that works around them. The initial fortification in this new architecture is the establishment of an emergency fund, which must take precedence over every other investment vehicle. I can practically hear the collective sigh of the ambitious investor. You likely view cash reserves as a dull waste of potential, a stagnant pool of capital that isn't pulling its weight in the market while it could be compounding elsewhere. But you must reframe the utility of this money. This isn't about yield, it is about psychological insulation. When your transmission fails or a pipe bursts and you have zero liquidity, your body doesn't crunch numbers like a spreadsheet. It enters a state of high alert survival. Your vision tunnels, your cortisol spikes, and your capacity for long-term strategy evaporates as you scramble to kill the pain of the crisis. This desperation is the exact mechanism that funnels people into the predatory jaws of payday lenders, high-interest personal loans, and credit card traps that offer instant relief at the cost of your future. While the standard textbook recommendation dictates a reserve of 3 to 6 months of living expenses, that number often feels like a mirage on a distant horizon. To build real traction, you need a finish line you can actually touch. Set your sights on $1,000 first. While $1,000 won't retire you, it serves as a vital circuit breaker for the majority of life's smaller shocks. More importantly, it provides your brain with a goal that has defined borders and a clear end state. Our minds are notoriously bad at navigating the fog of vague objectives like financial security, but they excel at completing concrete missions. Once that $1,000 is locked away, the psychological weight shifts. You move from the terror of being one minor misfortune away from total insolvency to a state of guarded composure. The small victory generates the momentum necessary to scale up to 1 month of expenses, and eventually 3, replacing the need for fragile self-discipline with the unstoppable power of a winning streak. Once that initial firebreak is in place, your secondary objective is the systematic destruction of high-interest debt, which encompasses anything carrying an annual percentage rate of 8% or higher. This includes the usual suspects, credit cards, payday advances, and those personal loans with predatory, ugly terms. It is tempting to argue that you can outperform these rates by aggressively playing the market, but we need to inject some cold reality into that fantasy. You might have a stellar year in equities, but you might also face a downturn. Conversely, erasing a 22% credit card balance is the only financial move that offers a 100% guaranteed return. It is a mathematical certainty in a world of variables. By eliminating that interest, you aren't just paying a bill, you are reclaiming a portion of your future income that was being siphoned off by your creditors. This is the bedrock of your new system. The human mind is a master of self-deception when it comes to the true cost of borrowing, often viewing a $5,000 credit card balance at a 22% interest rate as a simple, static hurdle. We see the number as a fixed point on a map rather than a living, breathing predator that grows larger the longer it is ignored. Your biology is not equipped to naturally sense the silent weight of interest compounding over years, manifesting as a persistent leakage of your future wealth and a drag on every other financial move you attempt. Think of high-interest debt as a parasitic infection that feeds on your progress while you are busy looking at the horizon. You must shift your perspective to realize that liquidating this debt is actually the highest-performing investment available to you. It provides a guaranteed return that exactly matches the interest rate you are no longer forced to pay, offering a level of certainty that no brokerage account can replicate. When it comes to the actual mechanics of killing these balances, you generally have 2 tactical options. The first is the debt avalanche, where you maintain minimum payments across the board while funneling every spare cent toward the debt with the highest interest rate. This is the undisputed champion of logic and mathematics, as it minimizes the total amount of money lost to interest. The second is the debt snowball, which prioritizes the total elimination of the smallest balances first to generate immediate psychological momentum. While the avalanche is technically a superior engine, the snowball serves as a powerful fuel for the human spirit. If the small wins of the snowball keep you in the game when you would otherwise quit, then it is the superior choice for your specific situation. The most theoretically perfect blueprint is completely worthless if you leave it on the drawing board. The only system that matters is the one you can sustain until the job is done. There is, however, one critical pivot in this sequence that defies the standard logic of debt repayment. You must aggressively pursue your employer's retirement match even while you are still under the shadow of high-interest balances. It may feel counterintuitive to divert cash away from a 22% debt, but a company match is not a standard market return. It is a locked-in, instantaneous windfall. Consider a professional earning a $50,000 salary with an employer who matches 50 cents on the dollar up to 6% of their pay. By contributing $3,000, that individual receives an additional $1,500 from the company immediately. That is a 50% return on investment before the funds even touch a single stock or bond. This is the definition of free money, yet our brains struggle to value it because the reward is stored in a distant, untouchable account rather than hitting our checking balance today. To solve this, you must automate the contribution through payroll deduction, removing the daily friction of choice and preventing your brain from feeling like it is losing something vivid for something abstract. Once you have secured that initial match and cleared your high-interest hurdles, the next logical milestone is to prioritize your individual retirement account, or IRA, before putting another dime into your 401. Why should you favor the individual account over the corporate plan? The answer lies in the hidden erosion caused by limited options and parasitic costs. Most workplace retirement plans are essentially closed ecosystems filled with expensive mutual funds and quietly harmful fees that benefit the provider more than the employee. While a 1% difference in fees may seem like a rounding error in the short term, it can actually devour a massive portion of your total wealth over several decades of compounding. By moving to an IRA, you gain access to a vast universe of low-cost investment choices that keep more of your money working for you. This creates a refined hierarchy for your capital. Start with a foundational emergency fund, crush high-interest debt, capture the full employer match, and then shift your focus to maxing out your IRA. The math of wealth isn't built on grand gestures, but on the relentless arithmetic of time and the silent erosion of fees. When you transition your focus to an IRA, you are essentially trading a high-priced, restricted environment for the open market, where low-cost index funds carry expense ratios that make employer-sponsored plans look like highway robbery. While a fraction of a percent might seem trivial today, over a 20 or 30-year horizon, that gap transforms into a fortune that either stays in your pocket or lines the pockets of a fund manager. For the 2025 calendar year, the IRS allows you to shield $7,000 in these accounts, or $8,000 if you have reached the age of 50. The real psychological hurdle for many is the binary choice between traditional and Roth structures. Traditional contributions offer an immediate tax deduction now in exchange for a tax bill during your retirement withdrawals, while the Roth path requires you to pay your dues today so that every dollar you pull out later is entirely tax-free. Does the fear of picking the wrong tax bucket keep you awake at night? If you find yourself in the peak of your earning years with a high tax bracket today, the traditional route is often a logical hedge against a lower future bracket. Conversely, if you are just starting out and expect your income to climb, the Roth provides a massive shield for decades of growth. However, the reality is that none of us possesses a crystal ball for tax law 30 years out. The ultimate failure is not picking a less optimum tax treatment, it is allowing the fog of uncertainty to paralyze your progress. Some of the most resilient investors choose to split their contributions over time, creating a diverse toolkit of tax treatments for their future selves. Action is the only antidote to the stagnation caused by endless comparison. If you are looking for the most lethal weapon in the financial arsenal, look no further than the health savings account, provided you are enrolled in a high-deductible health plan. It is a quiet, unglamorous tool that rarely makes for exciting conversation at a dinner party, yet it offers a triple tax advantage that is virtually unmatched. Your contributions are tax-deductible, the internal growth is shielded from the IRS, and every dollar taken out for medical costs is tax-free. For 2025, you can funnel $4,300 into a self-only plan or $8,550 for family coverage. The elite strategy here is to treat the HSA like a secondary retirement account rather than a checking account for doctor visits. If your cash flow allows it, pay for your current bandages and prescriptions out of pocket and let the HSA compound untouched. By archiving your receipts, you can legally reimburse yourself years or even decades later for these expenses, allowing the principal to act as a tax-free compounding machine in the meantime. Even after age 65, the HSA remains a powerhouse, functioning like a traditional retirement account for non-medical needs while providing a tax-free reservoir for the inevitable healthcare costs of aging. Once these specific valves are filled, the final maneuver is to return to your workplace 401 and ramp up your contributions toward the ceiling. For 2025, the employee contribution limit stands at $23,500, with even more generous catch-up provisions available for those in the later stages of their careers. By the time you are maxing out an IRA, leveraging the unique tax geometry of an HSA, and pushing your 401 beyond the initial match, you have moved past the realm of basic survival. You are now operating in a tier of financial discipline that the vast majority of the population never manages to achieve. This is where the foundation of true independence is poured, moving beyond the noise of the market and into the quiet strength of a completed system. Taxable brokerage accounts represent the final frontier of a sophisticated financial architecture, yet they are precisely where most undisciplined investors try to plant their first flag. While these accounts offer immense utility and the freedom to access your capital at any time, they are essentially high-friction environments for long-term growth. Unlike their tax-sheltered cousins, taxable accounts suffer from a persistent tax drag that siphons off value every time a dividend is issued, a gain is realized, or a portfolio is rebalanced. This friction acts like an invisible anchor on your compounding engine. You should only initiate this phase once you have established a fortress-grade foundation consisting of a liquid emergency fund, a zero balance sheet on high-interest debt, a fully captured employer match, and maxed-out contributions to your IRA, HSA, and 401 accounts. Once that gauntlet is run, the taxable brokerage becomes a powerful tool for bridging the gap to early retirement or accumulating wealth that exceeds the restrictive limits of government-sponsored plans. If you find yourself looking at your current balances and realizing you have been executing this strategy in reverse, do not succumb to the narrative that you are incompetent or uniquely flawed. You are simply a human being possessing a brain that evolved to prioritize the vivid and the immediate over the abstract and the distant. Our biology craves the visible progress and the emotional hit of a winning trade, often at the expense of the boring, invisible gains that actually generate generational wealth. The true masters of money are not necessarily those with the highest IQs, they are the individuals who have recognized their own cognitive fatigue and decided to automate the mundane mechanics of their lives. They have accepted a reality that most people find repulsive: the actual process of getting rich is remarkably quiet, repetitive, and emotionally flat. It offers no thrilling stories for a dinner party and provides no rush of adrenaline. By adopting this specific sequence, securing your starter emergency fund, crushing predatory debt, grabbing the employer match, and systematically filling your IRA, HSA, and 401 before touching a taxable account, you are doing more than just moving numbers. You are creating a psychological environment where panic cannot survive and where your tax-advantaged returns are mathematically maximized. You are opting out of the high-stakes financial chaos that often parades around disguised as a once-in-a-lifetime opportunity. While the rest of the world is glued to their screens chasing a dopamine hit from a fluctuating green line on an app, you are building a resilient, automated structure. True financial dominance is not found in the excitement of the hunt, it is found in the willingness to build a system so robust that it succeeds even when your own exhausted mind would rather be doing anything else. This quiet discipline is your ultimate competitive advantage.